Hello, good morning everyone, and welcome to reInvent. This is session STP 201, How BlockFi Scales to Meet Demand for Crypto Asset Services. My name is Manish Chugh, and I'm Senior Solutions Architect at AWS. I'm based out of San Francisco office, and I have worked with organizations ranging from large enterprises to early stage startups. In my day-to-day job, I'm responsible for helping customers architect scalable, secure, and cost-effective workloads on AWS. And joining me on stage today, I have Adam Healy, Chief Security Officer, BlockFi. BlockFi is a crypto asset services startup based in New Jersey. I was talking to Adam last couple of months while preparing for this talk and got a chance to know his team very closely and also about BlockFi business, what they have accomplished in last 18 months. In a short while, Adam will share with us BlockFi journey and how they have accomplished this goal on AWS. He will also share with us what went well, what did not go well, and how did they scale to these numbers. And at the end, he will provide a forward-looking outlook as well. A lot of ground to cover, so let's get going. A quick check of state of fintechs and blockchain in 2021. Global markets and networks are expanding like never before. Businesses are engaging in new ways of financial transactions. This demands the ability of these businesses to partnership with fintechs who could rapidly implement new technology, which are critical to stay competitive. Overall, global fintech funding soared to a new high in first half of 2021. According to KPMG Pulse of Fintech, global VC investment in fintechs reached to a record $52.3 billion in first half of 2021, more than doubling the $22.5 billion seen in the second half of 2020 last year. Another interesting trend is blockchain is fast becoming mainstream technology, which allows secure way for individuals and businesses to deal directly with each other without an intermediary like a government, bank, or any other third party to reduce the inefficiencies or redundancies. Global investment in blockchain and cryptocurrencies leapt in the first 3 quarters of 2021 with US $22.5 billion raised and almost 1,200 deals sealed, according to PitchBook. The investor base for the crypto industry has broadened, with substantial sum of institutional money flowing into the sector. And last but not least, we are also seeing some significant financial services blockchain workloads move to production on AWS. Last couple of years, we starting to see blockchain projects related to clearing, settlement, trade finances, correspondent banking, and mortgage loan application emerge on AWS. And for that matter, new fintech startups that we have observed in Northern America for the past year, roughly 25% of them are related to blockchain and cryptocurrency or any other digital assets. So blockchain is no longer considered potential. It is production. And with convergence of blockchain and cloud, the pace of adoption has accelerated like never before. Cloud infrastructure, elasticity, scalability, security, and ecosystem of managed services reduce that undifferentiated heavy lifting for our customers, and then blockchain customers can focus more on their core business use cases. AWS has many blockchain customer success stories, and one such customer is crypto asset startup customer BlockFi. BlockFi is one of the fastest growing crypto asset services startup company in Americas. They have grown from 75,000 funded retail customers to almost 1.6 million retail customers, and from $1 billion to $15 billion in assets under management. Exponential growth there. They have also closed on a massive $350 million Series D funding that values them at $3 billion today. It's even more impressive when you consider they just closed $50 million Series C funding in last year at $450 million valuation. Amazing growth, exciting company, love it. So without any further delay, let me invite Adam Healy, Chief Security Officer, BlockFi, to share their story. Adam, over to you.
Thanks, Manish. It's great to be here with everyone today. Before we get started, I think it's important to welcome everyone, whether you're been in the crypto ecosystem, the digital asset ecosystem for some time, or you're just getting started. The industry has a lot left to grow, and we'll talk about that. And we'll also talk about the BlockFi journey in the subsequent slides. Before we get into that, though, I want to introduce myself. As I said, and as Manish said, my name is Adam Healy, and I'm the Chief Security Officer at BlockFi. In all honesty, I really don't know how I got here today. I've done a lot of things, to include working at places like Microsoft and Palantir, and I even spent a year out in Colorado trying to figure out how to provide banking services to the legal cannabis industry. And during that time, I somehow got attracted to a lot of work that's centered on internet money. Or Bitcoin at the time seemed to be the most popular. And while it still is, there's a pretty rich ecosystem that's not Bitcoin in the market today. This was in 2016, and Bitcoin was about $500 a coin, which is quite interesting to think about when you consider where it is today, and before it was cool and before it was really mainstream crypto. And then later into 2017, I got into crypto full-time with the boom cycle that many really were just becoming first aware of Bitcoin and the broader ecosystem. At BlockFi, I manage a number of different functions, to include leading security, as my title would imply, but also managing our fraud team, our DevOps team, cloud engineering, SRE, and things along those lines. As I like to joke, it's all the things that a CISO really should be responsible for at the end of the day. It means I don't get a ton of sleep managing this team, just over 100 individuals globally distributed across the world. And we'll talk a little bit more about the challenges of not only scaling out those functions within BlockFi, but the broader BlockFi workforce over the last 18 months, just as we'll talk about scaling out our external-facing, client-facing infrastructure, and really kind of some of the journey that went through that, both things that we did really well and things that we maybe didn't do so well. At any given day, as Manish said, we manage a lot of crypto assets on behalf of our clients. And depending upon the price of Bitcoin, that usually hovers in the mid-teens of billions for us. One thing that I do always like to touch on, as I'm in front of a room full of technologists, that I will point out here as well, is I'm going to use the term crypto throughout this presentation. And what I really mean is cryptocurrency, not cryptography. Although you can't have one without the other. I just want to be clear, as some people tend to get a little worked up on that. So cryptocurrency, in my opinion, just has better marketing as compared to traditional cryptography. So when I say crypto, that's really what I mean, just so we're all on the same page. Next, talk a little bit about what is BlockFi. Some of you may be familiar with the company already. Hopefully all of you leave here as clients or shortly thereafter become clients. But what BlockFi really is we sit in the middle. We sit in the middle between retail or Main Street investors and institutions or Wall Street counterparties. And what does that mean? It means we have a number of different services that we offer both to the consumer as well as to the institution. Our current and newest service that we offer, or financial product that we offer, is a Bitcoin rewards credit card, co-branded with Visa. It allows you, as any individual consumer, to spend dollars, and instead of getting frequent flyer points or other types of rewards, it allows you to get back fractional pieces of Bitcoin deposited into your BlockFi account that are then yours, and you're free to do whatever it is you would like to do with those assets. That's really our newest product that has gotten massive traction. Some of you may have seen our ads in your travels here today as part of traversing airports in your day jobs across the last year or so since we started really marketing that. And it was the first Bitcoin rewards credit card on the market. But over the last 3 years, we've actually had a number of products that we've offered both to consumers and to institutions, yield earning accounts, trading and lending, as well as more focused on the institutional side, things like prime services. And what we do is we sit in the middle of this. So a retail investor can deposit cryptocurrencies into their BlockFi account, earn a yield on those assets, and then we, very similar to any financial institution that all of you currently work with today as part of your personal lives and likely your business lives as well. We partner with institutions to do things with those assets that allow us to, one, pay the yield, but also conduct different types of transactions and financial products with those institutions.
So Adam, you seem to operate a lot like traditional financial firms. Would you agree with that?
I would. The one difference I would say is we're really geared towards the crypto native capabilities that blockchain and cryptocurrencies bring to bear. So cutting out inefficiencies, cutting out redundancy, adding to user experience through cutting edge technology, as well as enabling users to, if they want, move their assets off the platform and to kind of keep with the ethos of cryptocurrencies, really kind of be their own bank in many ways. So while the assets, however, are on the platform, we do sit in the middle, much like a traditional financial institution, helping bridge that gap. And we do see clients, some of who are crypto purists, crypto natives, all the way to sophisticated institutional investors at hedge funds or banks, and then the family offices and high net worth in the middle as well. So we have products for all of those types of investors, and our ability to service those is only growing as our infrastructure has been scaling up.
Yeah, thanks.
So it's really hard to tell how we scaled without a couple introduction slides. The slide on the left here is the price of Bitcoin over the last 18 months according to CoinMarketCap. If this was anyone that's building infrastructure, if this was the volatility that your infrastructure was subjected to, it would be really hard to plan. We could probably all agree with that. And our scale story tracks really closely to the price of Bitcoin. Not surprising, but something that's really hard to predict. I mean, if I could predict the price of Bitcoin, I probably wouldn't be here with all of you today. That being said, it becomes incredibly complicated as it's different than scaling infrastructure for, say, traditional e-commerce, where you can optimize around key events of the year, such as Black Friday, or scaling infrastructure for traditional financial services, where maybe a Fed interest rate decision is going to drive certain trading behavior from your institutional counterparties. Our scale story really tracks to the volatility of the crypto ecosystem and makes it very difficult to know ahead of time what may or may not happen. And that creates a lot of tension in terms of how are we investing, but not over-investing, being cost conscious, but at the same time servicing our clients and being able to service our internal workforce. But what does this really have to do with the talk today? Well, it means that as technologists, we need to be able to design and future-proof our systems to allow for scales and surges of user activity that can happen with no notice. And when that does fail, it can cost the company millions of dollars of lost revenue in minutes, and perhaps even more to our clients that are potentially looking to execute large trades with a platform that may be unavailable. And this is an increasingly common talking point today. Squawk Box on CNBC pointed this out broadly about the industry just recently, and even some US senators have been mentioning this in interviews with media outlets, that the volatility that occurs within the crypto markets generally will impact platform availability, even among the leading providers in the space. Certainly, I would put BlockFi in that category. It becomes difficult to scale this infrastructure without having a lot of additional costs ahead of time. I mentioned during my intro that I spent a year trying to figure out how to legally provide banking services as a fintech to the cannabis industry out in Colorado. You really can't, is the spoiler alert there. But that was the first time that I walked into the US Capitol to speak with a congressman about this particular topic, fintechs and that particular industry. While the whole time I was in the Capitol, I was thinking I was going to be arrested, because at the time it was still very fringe as it was being legalized across the country. But I'm starting to see in conversations that we're having and others in the space are having, media attention, lawmaker attention, that crypto is really kind of in that same space just a few years later than where that other industry was back then. So I think there's a lot of room left to grow, and the scale problem is only going to increase. And the ability as technologists to service those scale problems is only going to become larger and larger of an opportunity due to more and more consumers and institutions embarking in the crypto space. Every startup has the hockey stick graph in their pitch deck. It looks great, but it's really hard to make a reality. This was ours, and we just came out of a hypergrowth curve, and frankly, the last 18 months was a blur. But I think as we talk about scale, I wanted to specifically talk about these two slides as well. On the left, you have clients by month. These are funded accounts, and while we have considerably more accounts on the platform, client identities that we have to manage, there are only a subset of that would obviously be funded, but we have to manage all client accounts as if their identities to protect. And the slide on the right is assets under management. This directly tracks to the price of the main crypto asset, specifically Bitcoin, but really goes to show just how the company went through this hockey stick growth curve, and some of the things that we had to do, you can imagine, internally to service this type of growth. This was really compounded by us having to not only scale our external facing infrastructure, but also our internal facing infrastructure as well, as our employee headcount went from about 200 to just over 1,000 in the same 18-month duration. With this scale comes a lot of client data, cryptocurrency private keys, API keys to manage. I often say that we have every problem any fintech has, and then we also have to manage $15 billion in crypto assets. So it becomes very complex, and the services that we need to use are significant, and they need to be high trust. And we need to be doing implementing those services with good partners as we're looking to manage these very sensitive workloads as we go through these periods of scale.
So, Adam, could not agree more on this with you. Amazing hockey stick growth. So, how AWS, as one of your technology partners, helped you in this journey and the client base growth and this scale? If you can tell us more about that a little bit.
Sure, it's a great question, Manish. I think beyond just the obvious, having bulletproof technology that we can out of the box begin to scale up, and not just scale up, but scale out and then deliver to a global client base and also a global internal workforce. Those are, I would say, the table stakes. But it's that kind of deeper level of partnership, being able to partner with the account team and make sure that we're getting discounts in the right places, that that we have a lever to reach back into the broader AWS ecosystem, both for partners, but also teams internally. We'll talk a little bit more in some subsequent slides about some work that some conversations that we've recently had with the Nitro team around using trusted execution technologies and some of the value that we're seeing out of that. But in reality, it's been a great partnership because we've been able to bring to bear the full weight of AWS as we've gone through this scale story. And again, doing this in 18 months is very difficult. You don't build a $4+ billion business in 3 years without a lot of tech debt and security debt and about every other kind of debt that you can imagine. It comes with the game, and it's no different than what many of you have all gone through. I wish I could be here today in front of all of you and say that we made no mistakes. However, that's never true. I wish I could say that we never had to rebuild major parts of our infrastructure, major components of our stack. That's also not true. We knew exactly where we wanted to invest, but we learned a lot of lessons along the way. However, it wasn't all firefighting and late night incidents, and a lot of those lessons we did get right the first time. We knew going into this that we wanted to make some decisions up front. We knew we wanted to build a global company that could leverage remote talent across the world, and we knew that we'd be going after a global client base that was really similar in terms of our employee base, globally distributed. This meant we would not only need availability and resiliency in our technology in the US, but also needing to be able to scale the platform globally in a way that allowed us to comply with really complex and still changing regulations and compliance requirements across a global pool of regulators. But this also included a lot of the things that are still hard to do today. Rapidly provisioning internal services was simplified, and we were able to invest in things like workspaces and other technology that, while we were scaling our external-facing client infrastructure, we were able to scale up our internal-facing infrastructure and quickly onboard new employees, quickly onboard temporary consultants and contractors, and invest in that infrastructure with AWS to make sure that we were still delivering to the edge of our clients all the services that they came to expect. Again, we learned a lot of lessons, and this did not always go incredibly smooth, but we, along that journey, certainly had a number of outages that allowed us to reinforce our infrastructure. And we did this through really doubling down on the core technologies that many of you, surely all of you, use today. Things like RDS and ECS and Lambdas, and building a comprehensive architecture, oftentimes in partnership with AWS, that allowed us to get where we are today, servicing 1,000+ employees located in 22+ countries, clients located in over 50 countries, and still scaling and able to meet global regulator and global concerns of different governments and compliance regimes has been quite a journey, but using AWS as a foundation has allowed us to get there. So in my last role, I was the CISO at a subsidiary of Intercontinental Exchange, which is the parent company of the New York Stock Exchange. I always have to say that because not everyone knows NYSE, but no one really knows ICE. There, we could block major portions of the internet without any issues. As a B2B business, we didn't have the same issues that a B2C business has. Here at BlockFi, we're both B2B and B2C. So we couldn't usually, or we can never apply the same playbook at BlockFi that maybe worked at a different company because we're not only B2B and B2C, but we're also in crypto, which creates a lot of really interesting edge cases for our clients. It's often that we see clients accessing our platform through things like Tor, using privacy aware, being very privacy aware and using things like proxies and VPNs and other services. So it makes being able to run that infrastructure in a secure way a bit more challenging than you might find at say like a New York Stock Exchange or a large financial institution. Also, as I mentioned on the last slide, there's been an increased interest in global regulators, governments, different compliance regimes, with varying degrees of work needed to meet those requirements. It's always good, and I'm sure we can all appreciate, that having a lot of the compliance controls between SOC and ISO and NIST really out of the box with a lot of the AWS services has allowed us to meet those easily, but at the same time has given us a good foundation to build controls that are unique to our application and what we're running in the cloud in a way that is flexible and we can scale out. As I'd like to assume, all of us are aware with kind of the guardrails that come out of the box with a number of AWS services. So marrying those up with the different compliance certifications and security certifications has really allowed us to get where we are today. We need to be globally accessible, with the exception of a few countries that are bad actors. We obviously still need to block those. And we need to have the technical and compliance certifications to back all of that up. And to be able to attest to our counterparties and our investors and various regulators that we're meeting all of the right standards that they may have on us. And we also need a platform that's going to innovate at our pace. We need a platform that is forward-leaning, and we need a platform that has been able to continue to deliver new services and harden existing services in such a way that they're matching us in terms of how we want to ship products at a pace that is important to us and to our clients. A lot of those services, again, ship out of the box with guardrails in place. Something I like to say a lot is something I need to probably change in the age of COVID is you can take all the antibiotics you want, but if you don't wash your hands, you're still going to get sick. And that concept of hygiene is really applicable in any cloud environment when it comes to compliance and security. You need to be able to build the platform with as many guardrails in place and have good hygiene out of the box. So that way you're not, you're enabling your developers to move quickly, and you're not going to be providing an opportunity for someone to make an easy mistake without having to go through some rigor.
Adam, this makes a lot of sense. And for any fintech, especially a crypto-based one, can you give some examples of how you see crypto users being at the bleeding edge or really pushing the technical and security topics?
Sure, it's actually an interesting conversation to have. In the slide here, there's a screenshot of a post from Reddit. It was actually a Reddit AMA I did sometime last year, and the reality is as I mentioned before, a lot of clients in the crypto ecosystem are very privacy aware, and they use things like Tor and VPNs and other things, but they also ask really good questions. And if we set aside just the institutional and traditional financial services firms that do very thorough diligence on any partners that they're working with, us included, our retail clients are actually very smart, and they generally tend to be more tech savvy. They generally tend to be more privacy and security aware. And as you can see, and I'm not sure how clear this screenshot will be, but as you can see in this particular screenshot, these are very good questions that a random consumer retail investor has about the health of our infrastructure and the security of our platform. And we see a lot of this. I actually see a lot of this. People will DM me on Twitter and ask a bunch of very specific questions that they worry about before they move money onto any crypto platform. Everything ranging from two-factor authentication to DDoS protection to encryption and backups, and it really runs the gamut. But it's very interesting to see such an invested client community that has really good questions to ask, and it's not something that you generally see in many other ecosystems or many other industries. So let's get in a little bit to some things that went well, and some things that I think we did pretty well early on. It seems that a lot of startups make a few common mistakes. At the time, those decisions are made with the best intentions, and they're not really seen as a mistake, but really as an operational requirement needed to enable moving fast. We were no different, and we'll talk about some of our mistakes and some of the tech debt that we accrued. But the things that we did do well, I wanted to just put on a simple slide and talk through those. First and foremost, we invested in code standards and good code quality early on, not just for critical service, but definitely for critical services. It was really important that we had good standards and good hygiene around code and quality, and that we were preparing ourselves to scale up without having to refactor deeply embedded services. It's always easier to do it right up front. Sometimes, again, doesn't mean you're going to be able to move as fast as you may like. But something that we've also learned is having to refactor critical services later is really sticky. It's really difficult, and especially when you're running app production at a large scale. The next thing would really be around QA and QE, tools, processes, people, all of those things. My opinion is you shouldn't wait to hire your 25th engineer before you start to think about quality assurance, quality engineering, and taking testing seriously. Load testing, security testing, all of those things really need to be baked in and not, as they say, bolted on. It would certainly behoove of anyone that's starting to scale, and if you're starting to hire 20, 25, 30 engineers, to really take a step back and think about how are you going to start to invest in quality, especially in any regulated industry, whether that's financial services or healthcare, because eventually regulators will start to ask questions, and you want to be able to tell good stories around how you're doing quality and how you're doing code reviews and how you're managing kind of the end-to-end SDLC, as it will be pretty critical as you start to go through some audits later on. The next thing I would touch on is really the value of data. It's almost cliche today to think about valuable data. Everyone generally agrees to that. Data is, the new oil, is I think one article talked about it years back. It's really important though, especially in retail-focused businesses, to understand the value. We did, and we started to capture all of that data, but it was only really until recently that we started to invest in using that data. We recently started to invest in our data science and machine learning capabilities, and we'll talk a little bit more about some of that in a later slide. But understand the value of your data, get control of your data sooner than later, and if nothing else, just begin to store it. The next would be moving to something more akin to microservices. This should be common sense. Most of us may agree on that, maybe not. But moving away from a monolith as fast as possible is something that we learned very early on. Having one failure within any service or any one system cascade across a series of other services or systems is really the core of what causes a lot of the downtime in the crypto ecosystem today. So moving to microservices, we made those investments early. We saw what was happening and allowed us to really become more modular and decouple a lot of our internal infrastructure from one another, allowing us to meet scale in a much more rigorous way. So now on to the part that everyone likes, the things that did not go so well, or the things that could have been better. Every time I see the down thumb, I think of the movie Gladiator with Russell Crowe in the arena. I don't know why I think of that. It's just every time I see a down thumb emoji. One of the things that I've seen us do, and I've seen a lot of other startups do, is worrying about the distant future of technology decisions too early. Well, in 3 years, if we scale, we have to think about X, Y, Z. That sounds great, and it's good discussion to have, but the reality is there's a lot that's going to change about your company, about your business, about your technology, and about your people in the next 3 years. Think about trying to plan ahead of time, but not too far ahead of time. It's a delicate balance, and it's difficult to do, but making technology decisions where you're trying to future-proof too much will actually set you back in the near term. I think the reality is we all want to know what's going to happen, and we all want to plan for the worst, or in some cases, plan for the best and build something that's infinitely scalable. But in the startup world, you're only going to be able to plan for about 6 months ahead of time in reality. I think back over the last 18 months, and if we use that 6-month block of time for us at BlockFi, the company has dramatically shifted. The people, the technology, how we think about problems, about every 6 months. And while the company is about 3 years old, I can only really attest to the last 18 months firsthand. But that journey we've seen, and I've lived, a pretty significant shift about every 2 quarters, in some cases every quarter, about what's important to the industry, where things are going, what consumers are wanting, what types of financial products institutions are wanting. All of these things pull and tug on your infrastructure and your tech stack in different ways. And if we would have spent a little less time worrying about 2 years or 3 years down the road, we would probably have been better off in the interim and been able to meet the demands of our clients as they were existing today and tomorrow. So I like to think about 6 months as the max of where you should be thinking about technology decisions and what's going to be impacting you then and what you want to be building today. And there's a few caveats to that, of course, but that's a good rule that I like to follow. The next is spending time trying to prevent vendor lock-in. Now, there maybe are some good reasons why you want to prevent vendor lock-in. Again, everything's a dichotomy, everything's a balance. But something that we did, and something that I see a lot of other startups do as well, is they worry about, well, what if AWS 50x is the price of this service? Well, that generally doesn't happen. We can all kind of agree to that. And price is only one aspect. Others are, well, we want to be able to go multi-cloud. We want to be able to do, whatever it might be. And we're going to think about, how do we prevent vendor lock-in? How do we architect and build services that don't marry us to this provider or this partner? It's great in theory, and I think there's a place for that once you hit a certain scale. But as startups, we need to get to that scale first. And spending time outside of your core competency, for ours at BlockFi, it's building financial services products for both retail and institutional investors. That's our core competency as a business. Technology, security, everything else is just an enabler to that. So we like to focus on providing those core competencies, providing those services to our clients, and pick the most straightforward, while being the most secure and scalable mechanism to build on. And we don't really focus too much on vendor lock-in. We did at one point, and it really ate up hundreds and hundreds of engineer hours that we could have spent on those core competencies and building better and more efficient and more attractive products, financial products for our clients. And that's probably, in hindsight, something we should have done. And instead, just pick good partners, pick and invest in those partners, and move forward. The amount of time that you'll spend trying to build to prevent vendor lock-in will be equal to or less than the amount of time that you spend migrating away from those partners at a future date if for some reason something doesn't work out. So you're either going to spend the time now or later. Much better to ship product, get things out the door, scale your company, and then deal with that and spend those engineering hours later. One thing that is real sticky and real difficult to do, and might be one of those things that you do actually want to think about a bit ahead of time. And this is really kind of, I would say, specific to any type of startup that is going to be servicing a variety of different client bases. And that's client identity management. You can certainly, there's always this balance that exists, fast versus functional. For us, this was something that we struggled with for a very long time. And it's difficult because we service two very different demographics of clients. One demographic, let's say the consumer or retail demographic, is going to be primarily focused on single account identities, primarily focused on things like beneficiaries and how do you reset two-factor authentication and those types of things. And then institutions is going to be focused more on a hierarchical account. I want my accountants to do certain things. I want my traders to do certain things. I want to have SAML integration with our IDP. And those are going to be the types of things that are going to be unique to your business, but is really important to do well up front. We certainly paid the tax for that. We made some bad decisions with this early, and it ultimately led us down a path that we had to engineer our way out of. And it was complex. It took a lot of time. Frankly, it was rather messy, and it certainly impacted clients because we were requiring 2FAs to be reset and passwords to be reset, and it was kind of clunky. So this didn't go very well for us. It's one of those things that will be unique to every business, but it's certainly something, again, I talk about dichotomy and I talk about balance. This is one of those areas where you may want to focus a little bit of extra and really think through what's the target clients that you're going after. Now, that may not matter if you're going to massively pivot in a year and you're going to go from one extreme to the other of the client type, but it's certainly something you want to think through and plan for ahead of time. So as we think about where we're going next, I think it's important to kind of take a second, pause, and think about how it started and how it's going. Now, I'm a little too old to really be on most social medias, with the exception of Twitter. But apparently this is a meme thing that is happening on a lot of the social platforms today. So the article on the left from the Times, Chancellor on the brink of second bank bailout, is incredibly important in the world of cryptocurrencies, and specifically Bitcoin. That headline was actually enshrined in the Genesis block of Bitcoin. And in many ways, those that are, I would say, more philosophically aligned to the future of digital assets or Bitcoin see that as having immutable and having tamper-resistant money. Essentially, the shape of money changes from where it is today, primarily centered on the political sphere, to one that is immutable and math-based, as really one of the fixes to one of the many symptoms. If you look at the date of the article on the left, right after the financial crisis in 2008, 2009, but Bitcoin solving, digital assets solving one of the symptoms that caused that crisis. And then just a handful of years later, where we are on the right, JP Morgan giving their wealth clients, so essentially their wealthiest of clients, their private wealth clients, access to crypto funds. So it's amazing to see just how far we've come in about 11, 12 years, and really what still remains for the entire industry is a lot of unknown. But there's a saying in the crypto space, which is like, take it to the moon. You know, the Bitcoin price goes to the moon, or if you follow Elon Musk, the Dogecoin price going to the moon. So there's a lot of space memes in the crypto space, and that's where this graphic on the right comes from. But I think about that, and I think about the previous slide about how early we really are. And you intersect that with the Bitcoin white paper that started a lot of this in August of 2008. And we're really just getting started. We're only a handful of years in. And if you think about it as a proxy to where the internet was not too long ago, or maybe a dozen or 15 years in, there's still a lot of opportunity still to grow the technology, to grow the industry. And even given the age of the entire industry, the technology that powers it is moving very, very quickly. Massive changes have occurred just recently with things like Taproot and Schnorr signatures, a movement away from layer 1 transactions into layer 2, moving away from fully on-chain transactions. One of the technologies that we're most excited about, and something that we've actually had some discussions with AWS and the Nitro Enclave team specifically about, is the use of multi-party computation and what that means for the future, and what that means for creating quantum-proof wallets for digital assets in the future, and how to leverage a combination of MPC with things like trusted execution technologies, whether that's Nitro or similar, to create really high assurance transactions and really high assurance wallet infrastructure. More data, better insights, something that we've scaled up considerably, going from 1 to about 11 engineers is on our data science and machine learning side. Again, getting a hold of your data early is very important, and then making sure you're picking right partners. For us, partly why I'm here today, one of those key partners was AWS, but it was also being able to access other partners through the marketplace, individuals like Databricks and Confluent, and then also looking at native tools like SageMaker, and how are we leveraging that to do everything from predicting fraud rates to predicting transaction and withdrawal fluctuations, such that we're doing anti-fraud work, or knowing exactly how to balance wallet infrastructure as we scale out, as we move around assets, both on-chain and off-chain. And then things like managed blockchain to drive compliance and various other financial use cases, where a managed blockchain service provides a lot of value and a lot of and a lot of flexibility. So all this to say, we're very early. The plan and the goal is to really double down on the industry and help change and help drive through regulated financial products and bring together the retail, the consumer side of the business and the institutional side of the business, and really bring that together and build financial products that are interesting, that are competitive, and that allow any type of investor to really take full advantage of a democratized financial services infrastructure. And that's where we're going. And certainly one of those partners along the way has been AWS, and we're really glad to kind of have that partnership moving forward, and kind of what we built together we're very proud of. So Manish, I think back over to you.
Thank you, Adam, for sharing BlockFi's story with us. Thank you. So, how others can get started on AWS? Here are some of the useful resources AWS offers to get you going. First up, we have AWS FinTech Startup resources such as FinTech Startup Website, FinTech Quick Start Blueprints, and FinTech Snacks. So FinTech Startup website provides you an overview of why FinTech Startup choose to build on AWS. It also provides you a list of selected AWS programs fintechs can leverage to grow their businesses. And it also provides a wide selection of customer stories similar to BlockFi. FinTech Quick Starts are ideal for early stage fintechs just getting started on AWS or hoping to understand the architectural best practices as a fintech on AWS Cloud. This blueprint is packaged into a AWS CloudFormation template and can help you create networking, compliance, and security baseline in less than 30 minutes. Lastly, we have FinTech Snacks, a video series where we explore common FinTech startup use cases and how to architect for them. You can find FinTech Snacks on a YouTube channel. Then AWS also offers managed services to get you started specifically on blockchain area. We have Amazon managed blockchain service, which is a fully managed service that makes it easy to join public networks or create and manage scalable private networks using the popular open source frameworks such as Hyperledger Fabric or Ethereum. And we have Amazon Quantum Ledger Database, which is fully managed ledger database that provides you transparent, immutable, and cryptographically verifiable transaction logs. We have also published some quick start solutions on blockchain, so please do check out them on AWS Samples GitHub as well as AWS Solutions webpage. Last but not the least, please do check out BlockFi case study on crypto asset custodies. This brings us to the end of this presentation. Thank you for your time today, and goodbye.